Big bank earnings. As I mentioned off the top of the show, we've already received our earnings report from Bank of Nova Scotia. Disappointing. Bank of Nova Scotia has basically told us that they need to set aside more money for potential credit loss or bad debt down the road. Tomorrow, we're going to get, I guess, information or the latest quarterly results from TD Bank, CIBC Bank, Royal Bank as well. So a big day for bank earnings tomorrow morning. We usually get them before the market opens. What are these banks going to say? Well, many are anticipating they're going to say roughly the same things, that they're also setting aside a lot more money for bad debt, that they anticipate more credit loss, that business is slowing, loan growth is slowing. Businesses aren't as willing to take out a loan. People aren't as willing to borrow money to buy a house when prime rate is sitting at 7.2%. So overall, we are anticipating some soft earnings from the banks. Obviously, there are different banks will report, I guess, at different levels. Some may do a little worse than others. Perhaps Royal Bank might do a little bit better. We've seen Royal Bank able to weather the storm a little bit better than some of the smaller banks like BMO and Scotia. So we'll have to see, and CIBC actually. So we'll have to see how it goes. But I think overall, to me, the next chart I'm going to show you, a fantastic chart, really sums it all up. And that is the Canadian banks underperforming. And we have a chart here which clearly shows how much the Canadian banks have underperformed the overall index. We can see here that at this point in time, TSX is up roughly 5-6%, well off where the US markets are, which are the S&P is closer to 19% at this point in time. And the NASDAQ, well, NASDAQ is just shooting the lights out, 30+% at this point. But you can see how weak the Canadian banks have been. You can see it's actually negative, trending below the flat line. And this is because, once again, we're seeing a slowdown in the economy. As I say always, the Canadian banks, or any bank for that matter, is the bloodline of your country. The banking industry or the banking sector is the bloodline of the country. If the country is struggling, Canadian banks will struggle eventually as well. However, as I say often, I'm still a believer in these investments. I believe that as we get more and more information, as we parse through all the data, we're going to see that central banks are pretty much done raising interest rates. And I think that will be a catalyst for growth going forward. I think once interest rates and yields start to fall, I think businesses will be more inclined to borrow money. I think people will be happier, get a much more positive feeling. I think we'll see more growth, and that will be reflected in the loan growth. That will be reflected in the credit loss numbers. I think those numbers will come down. And I think banks will no longer need to set aside a lot of money for bad debt. So overall, I'm still a believer in the Canadian banks, even though we are expecting a weak earnings season. I think that owning a bank over the next 12-month period not only will give you some good growth later on down the road, so for patient investors, but also will pay you a fantastic dividend while you wait. Scotia pays over 7%, CIBC over 6%, BMO pays over 5%, dividends that is, and TD and Royal pay just under 5%. So don't give up on these banks. I think they're very good investments. They've never cut their dividends. The dividends will be intact. And I'm looking for some good things over the next 12-month period.